Good afternoon, and a pleasure to be here. In fact, ma'am has been after me, requesting me to be here for quite some time. But till the time I retired, I was always busy traveling, trying to resolve the customer issues in different parts of the country or concerning different subjects. Okay. So, Madam Sucheta and Devasis are not strangers. Okay. I had at least more than half a dozen meetings. I've accompanied them to the governor's office, to the deputy governor's office. I've taken them over, explained to them the rationale or the philosophy behind a particular stand that the regulator may take, or the customer may have missed out some point which is very important, or he or she. See, in terms of the institutional infrastructure or the architecture, India is ranked very high in the world. India is ranked very, very high. For the simple reason that we have a Consumer Protection Act which is in place. We have a banking ombudsman scheme which is in place. There is also a similar ombudsman scheme for the insurance. There is also an ombudsman scheme for the income tax. Now the telephone and electricity authorities are also going to come up with an ombudsman scheme. Okay. And then we also have for the banking customers in particular, Banking Codes and Standards Board of India. So we have the Banking Codes and Standards, we have the Consumer Protection Act, we have the Ombudsman Scheme. There are just about 12 or 13 countries in the world which have this entire umbrella of consumer protection architecture provided by the law and fully met through the budgetary support either of the government or of the regulatory body. So this is a unique feature, and this was appreciated by the fact that the financial sector assessment program of the IMF and the World Bank in 2012 rated India among the top 10 countries as a role model for other countries to look at how to evolve consumer protection, regulation and legislation. So that is a matter of pride for all of us. But having said that, does it mean that we are all well off as consumers or we are all well off as customers? We don't have grievances? We do have grievances. Okay. All of us at different points in time we do have grievances, and the reason for that is not very far to seek. The reason for that is, if you look at the word customer in the conventional sense, the way it has developed in banking, the word customer had the meaning of a person visiting that place of business as a matter of custom. So there was a tradition that the person had built of visiting that place for doing his financial business. That is the first part of the definition of the word customer. And the second part is, the person to whom he went for seeking the services was there to customize a solution for his needs. Okay. So there was a custom, there was a tradition of your visiting that place, and then there was the practice of the banker or the financial services provider customizing a solution to meet your requirements. Now, unfortunately, both these have been lost. Both these tenets of the word definition of customer, both of these have been lost, because from class banking, after nationalization, we moved to mass banking. From mass banking, we moved to automated banking. And from automated digitized banking, now we are moving to anonymous banking. So anonymity becoming the hallmark of the relationship. So how do you define the relationship? When anonymity, because today, earlier, if you look at the picture of a bank customer, 40 years back, 50 years back, or even when as a child also, somebody in place like Mumbai or Pune, wherever you went, somebody walking into a bank, you would always find him with a jacket, a tie, well-polished shoes. You never had the kind of footfalls that you are looking at the bank branches today, the way you see them operating with the millions of people using those services. So the profile, the way it had changed, coming from class to anonymity, it has also brought with it so many things that we need to understand. And one is, have we addressed the issue of what should be the appropriateness of the infrastructure to handle these many customers? Okay, so if you ask me, what are the problems with that infrastructure? There are two problems. One is, you have the mindset of the public sector bank, and the other one is you have the mindset of the private sector banks. Now, two distinguishing features of the people who deal with customers in these banks. The public sector banks know their banking very well, but they don't understand technology. The new private sector banks, they know their technology very well, but they don't understand banking. So, there is an absence of domain knowledge on both the fronts. It is not just the absence of domain knowledge on the banking side, there is absence of domain knowledge on adoption of technology, and there is absence of banking knowledge in deploying technology on the private sector side. And this particularly has been the problem created by what we thought was a very wise move, by saying about 12 or 13 years of continuous non-recruitment of staff in the public sector as a cost-saving measure. So there was no corporate legacy, or there was no legacy created to know how things have changed or how things have evolved over a period of time. Between the period 2000 to 2012, there was no new recruit joining the public sector banks. So people who have been customers of that bank, they have seen only people reducing in number and then saying the quality of service has gone down or the quality of customer care has gone down. Because see, the way the French people handle this problem, I can tell you, in France also they had the same problem. When they started automating the entire banking transaction in a straight-through processing model, the French did one wonderful thing. They said, okay, we are going to cut down the numbers, but what we will do is, in the banking industry, the total number of people that retire, we will recruit only 50% of that every year. So if there are 10,000 people retiring in 2000, only 5,000 were recruited. So by 2012, they have effectively brought down the number of people working in the banking industry by 50%. And contrast that with the Indian scenario. In Indian scenario, between 2000 and 2017, there has been an explosion. There has been an explosion of numbers. Today we roughly have 200 crore deposit accounts. All, taken together, multiple accounts, all taken together. Today, the actual number of customers is slightly less, but the number of deposit accounts is close to 200 crores. And we have around 40 crore borrowable accounts. That is loan accounts. So 240 crore accounts. So when you are looking at 240 crore accounts, what is the technology support and the manpower support that you require, even on a simple arithmetic average scale, to manage the relationships of these many customers? Okay. So you look at the numbers. When you look at the numbers, then you start getting an idea. Okay, where are these? Where are these customers? And mind you, 64 cities in India. 64 cities in India account for 60% of bank branches. Just 64 cities, I am not exaggerating the number. 64 cities with population of more than 10 lakhs. These are the 64 cities that account for 60% of India's bank branches. So the rest of the country, why it is underbanked or underprovided or underserved, is because of the reason that you are just having the rest of the country being served by just 40% of branches, and these 64 cities, and of that 64 cities, more than 40 are in West and South India. Okay, so I'm just trying to put the bigger picture in front of you so that we get. And then look at the products. Today, how many products are there? When I was a student of commerce or banking and all, there were just, on an average, what is the product? There may be 2 or 3 on the liability side and 2 or 3 on the asset side. Number of products. Today, how many products are there? How many products are there today?
200 plus.
There may not be 200. If you take even the liability side, there are the deposits. Each bank, if you look at the category of their interest rates, each bank has roughly 85 to 90 kind of deposit products. Okay. Now, if somebody were to go and ask, of this, what is the most suited for me? Are you going to get the best deal out of it, or are you going to get not so good a deal? Or what is going to be the guiding factor in your mind? If I tell you I have 89 schemes and you choose the best one, what is the one guiding factor you are going to be all guided by?
Bank's profit.
Huh?
Bank's profit.
I don't think. See, because if you look at that, most of the people are guided very, very blindly by the difference in the interest rates at the highest level of the interest curve. Nobody is so much bothered about the quality of the management or the quality of the governance of that particular bank. Otherwise, you can't explain why still so many people are crazy about going and putting their money in urban cooperative banks, where the number has come down from 2100 to 1400. 700 banks have been shut while I was in service. Okay. So we merely get carried away by what is the highest rate of interest at that particular point in time. And secondly, the consideration is, how far have I been with this bank? See, banking always has been a neighborhood concept. It has never been like you go walk 10 miles. That all came now when you started opening the branches in rural areas and urban, semi-urban areas. Otherwise, banking is always a neighborhood concept. You would always go to the bank that is nearest to you. So it doesn't matter whether it is UCO Bank or HDFC Bank. Only now we have tried to say, getting carried away by, array, this is promised, this is promised, this is promised and all. So having reached a stage where you have decided this is what you want, when you tell the banker this is what you want, does he necessarily sell you what you require? So that is the question. And when you tell what you want and he is not able to sell what you require, that is where the grievances start. Because that is the first point of misinformation or mis-selling, that's where it starts. See, many of the people who came in contact with me, who wrote to me, mis-selling, I said, you ask one fundamental question. Any banker who is telling you, invest in this, put your money in this, I said, first you must be able to clearly know whether it is a banking product or not. And that you can only know, the moment he says, put your money here, you are going to get 14%, you are going to get 15%. I said, one simple question you have to ask, whether a product is a banking product or a non-banking product is, will I get my principal back whenever I want it? If I put 10 lakhs, because banking by definition, all your fixed deposits and all, whatever you may say, 3 years, 5 years and all of them are repayable on demand. There is a position in law. Every single deposit, you can go and make a claim on the bank the moment you want it. That is a position in law as far as the banking. It is only because all the people don't come and ask for the money on the same day, and also because all the people don't repay the loan on the same day, that banking thrives. Otherwise, the principle of banking, if you want to test, you ask anyone who is trying to come and sell you an insurance product or a mutual fund. The basic question you have to ask is, if I have put 10 lakhs, will I get 10 lakhs and will I get it from you? I don't have to apply to anyone else. So that is the first test. And then the second question that comes is, am I being treated fairly? Now, what is being fair? See, we all get carried away by somebody talking to us very nicely. It doesn't mean he or she is treating me fairly. See, kindly, mind you, I have seen so many cases where the public sector may have sounded a bit rude, but I find they were more fair to the customers than many of the private sector banks or the foreign banks. People got carried away by the sales talk of the very wonderful young person and all this who will promise the moon, but nothing was delivered. Okay. So when you look at the problems and what the people are going through, coming specifically to the issues of the customers, last year, that is 17-18, under the two broad heads, grievances. For the industry as a whole, the number of complaints were around 2.3 million. And of that, around 1,30,000 came to the banking ombudsman's offices. Okay. Now, what is the banking ombudsman scheme? See, whenever you go to a bank, what you need to first know is, if I have a problem, what is my first access to the grievance machinery, grievance redressal machinery? And the second question you must ask is, if that base level grievance redressal machinery doesn't work, to whom do I escalate? So the ombudsman scheme of the Reserve Bank of India was based on these two principles: accessibility of the grievance redressal system by the common person and his ability to know the escalation matrix. If these two were not working, that is the grievance redressal machinery, the initial level access and the escalation mechanism were not working. See, the ombudsman scheme is a very, very simple scheme. No advocates are permitted. You have to just make a simple application. It can be non-fulfillment of promise, it can be short charging of short payment of interest, it can be excess charging of interest, it can be charging of usurious interest rates when you are switching over from floating rate to fixed rate or fixed rate to floating rate. So those 29 grounds are given there in the ombudsman scheme. And when you can complain? You can complain to the ombudsman at any time within 12 months of your noticing the mistake. Not within 12 months of the time of the mistake occurring. It is within 12 months of your noticing that there has been a problem. Like when you do come to know, suppose there is a wrongful entry, you may come to know only when you update the passbook or when you get a statement of account. So if you have noticed it today, and suppose the transaction has happened in 2017 April, and today you have noticed it, so from today within 12 months you can complain. So it is not within 12 months from the date of the event happening. Okay, this is to be very, very clearly understood. And when you complain to the ombudsman, the very simple thing first they say is, have you first complained to the bank? And has the bank reverted to you within 30 days or not? If you have written to the bank, if the bank has not returned to you in 30 days, you are free to directly go to the ombudsman saying, I had written to the bank, this is the 30-day provision. And 30 days is adequate even in the current scenario where the branches are very far, because most of the data and most of the statements and all are available on the core banking solution or the central information system of the banks. And the other thing is the pecuniary jurisdiction. The ombudsman pecuniary jurisdiction is 20 lakhs of rupees. That is, if you have suffered a financial loss which is quantifiable on account of the mistake of the bank to the extent of 20 lakhs, then the ombudsman has the jurisdiction. But let me tell you here, Supreme Court in a very recent case decided that while the ombudsman scheme may say pecuniary jurisdiction is 20 lakhs, nothing prohibits the customer, any customer, irrespective of the financial amount involved, going to the ombudsman. The Supreme Court or the High Court may reserve the right to modify the award passed by the ombudsman if it is in excess of 20 lakhs. That is the latest clarification given by the Supreme Court. So even if it is amount 1 crore, 1.5 crores, you need not be worried. You can still go to the ombudsman, take up the issue. In most of the countries, like in UK, where it is the Financial Services Ombudsman Scheme, FSOS as they call it, there every retail and individual customer is allowed, irrespective of the pecuniary jurisdiction, irrespective of the amount involved. No corporates are allowed. Whereas in India, we have been more liberal. We try to pick the pecuniary jurisdiction so that even the small and micro enterprises which suffer sometimes do get a chance to have a proper access to the grievance redressal mechanism of the regulator. Okay. So that was the idea. So it is not that it is restricted only to the company. Yes, you have some point? Okay. Then there is also within the ombudsman scheme, while the 20 lakhs is the compensation, there is also a clause, additional clause which says you can get 1 lakh rupees additional compensation for mental harassment. How does mental harassment occur? How does mental harassment occur?
The bank makes you run around.
No, ma'am, that may be something which may be reimbursed as a cost. Okay, but you, in the opening remarks, you gave a very good example. It can be you are wrong reporting to the CIBIL. Suppose it was somebody else's account, and instead of that number being put, your number was put, or your name and number being forwarded to the collection agency although you have been repaying the loan installments regularly, your name should not have been figuring in that list. So that amounts to mental harassment. So there can be umpteen grounds where if the bank has done something wrong, which it should not have done to you, there can be a case for mental harassment. Okay. So when the scheme was announced in 1995, we looked at the Swedish model. And the Swedish model we thought was the most appropriate one for the Indian conditions, wherein ombudsman by definition is a wise person acceptable to both the parties, but not involved in the transaction. Basically a third party. So we adopted the Swedish model, and the initial scheme, the way it was launched in 1995, was each bank would contribute to the share of the administration expenses. Only the ombudsman was appointed by the RBI. He was not a RBI person, the ombudsman, not necessarily RBI. There were one or two from RBI. And only secretary, not even the secretariat, only the secretary went from the RBI. So the entire scheme was run by the banking industry, with only the secretary to the ombudsman being from the RBI. But in 2006 to be precise, when the Supreme Court judgment on the ICICI Bank relating to recovery of loans, forced recovery of loans and harassment involved with recoveries came around, then the government and the Reserve Bank of India, we sat together and said, this is not going to work the way it was anticipated to work when the scheme was envisaged. So in 2006, the entire scheme was revamped, and the entire scheme was decided to be taken over RBI, fully funded with its own staff, including the ombudsman. So in 2006 was the first big departure in the scheme. So today we have 20 offices of the ombudsman. Other than in the northeast, every other state there is an office. Only in the northeast we have only one at Guwahati. Otherwise, in every other state we have an office today. We have office in Jammu, we have an office in Ranchi, there is one in Raipur. Everywhere there is an office. And then in 2009, we again modified the scheme to look at what was possibly the biggest effort in deregulation. See, in India, there has been a bit of a problem in the way we have gone about deregulating our banking business. In 1998, the advances related, loans related interest rates were fully deregulated. 1998. 2006, we deregulated the deposit rates fully. 2009, it was total deregulation because we said saving bank rate also to be decided by the banks. But only one change we made, and that was the change we made about daily balance being taken for purpose of calculating the products. So I made a detailed presentation to our Board for Financial Supervision, and the 5 to 10 bankers tried to oppose it, including State Bank of India, and we said nothing doing, because that has meant a difference of about 0.5% to the saving bank interest being earned by the people. Otherwise, if you all remember, it was always the lowest balance between 10th and 30th of the month that was being used by the banks. And today, with computing power available, with core banking solution available, there was no problem for the banks to adopt that particular strategy. So between 1998 and 2009, when the deregulation happened, unfortunately, we didn't have a mechanism of looking at how do you address the issues created by gaps in regulation. See, earlier, for everything you had the guidance from the RBI, you had the procedural guidelines, or you had the prudential guidelines, or you had the regulatory guidelines for everything. But after 1998, when the things started changing, there was a regulatory gap. And that gap created problems. What are the kind of problems? See, today, you are all talking of service charges. When you talk of service charges, see, kindly remember, this was the first question that was asked by the parliamentary committee when we went there and made a presentation. The first committee is, are the banks not there for rendering service? Why should they charge service charges? This was the first question that was asked. So the mere and simple logic to that is, we said today it is no more branch banking. Today the man carries the bank in his pocket wherever he goes, and he has access to the banking services anywhere, anytime. So the charges that are being looked at are in terms of the convenience and the effectiveness which the person is getting. So the members of parliament were convinced. But they asked, what is the underlying covet? What is the covet that you have? I said, covets are in terms of 2 or 3 things. One is, each customer must know what is the value that he is providing to the banker in terms of his relationship. See, today when you say, I've got 10 crore accounts with me as a banker, what is the value addition each account is making in terms of value to the business? And second, what is the time that the banker is spending on each customer? Is it that I have provided 10% business and I am visiting the bank not even once? Or is it that I am providing 5% business and I am visiting the bank 20 times every day? So the relationship time and the value added in terms of the relationship, those 2 things were the consideration. And then we said, the man in the street or the common person should be told very specifically by the banks that the charges that are being levied to him are on the basis of average cost incurred per transaction in that particular category. So the idea was, never there should be a situation where I am subsidizing somebody who is much better off than me. And this was based on the experience we had, a very bad experience we had in the Reserve Bank of looking at the BPLR or the PLR related loans. See, all of you know the PLR, prime lending rate, which was first announced after deregulation in 1998. PLR was the first kind of interest rate regime that was announced by the banks. Now, in PLR, typically, one thing happened. When you said prime lending rate, it means the best borrower get at the prime rate. Is it not? The best borrower. But then how come did it happen that 20% of the bank's portfolio was going at below the prime lending rate? So who was funding that difference between the prime lending rate and the money that was lent at below the prime lending rate? It was you and me, the common persons. It was a retail customer who was funding that difference. So that is the first big admission we had to make of things not working in deregulated environment, because we had not tried to look at how the people could be foxing the system in trying to look at how do I pass on the benefit to somebody else less deserving and not where it is actually due. So this was the first wake-up call for the Reserve Bank when we said PLR lending below the PLR, 20% of the portfolio going at 1.5% below PLR, 2% below PLR, and the retail portfolio the rates never coming down below 12% or 12.5%. So that was replaced by another committee, T.T. Ram Mohan, who was the professor of finance in IIM Bangalore. Then we got the base rate. Even that didn't work, because when you looked at the base rate, trying to get various components. This is the overhead. These are the tenor risk premium. These are the normal administration overlays. These are the normal provision requirements. So then I was there in the next committee also, which decided on the MCLR, marginal cost of lending rate. Again, that has its own flaws, marginal cost of lending. Because see there, marginal cost of lending, if you look at it, marginal cost is basically how much new deposit you get every year, which alters the marginal cost of your funds or marginal cost of deposits. When this issue was discussed, marginal cost related issue also was all discussed in detail. Mind you, if you look at the entire banking industry, the overall length of the portfolio of deposits is not more than 2 years. Somebody may be saying, I have put my deposit for 3 years, 5 years and all. But you look at the entire industry, Indian banking industry, the average maturity profile of the deposits is 2 years. And 2 years for the term deposit. If you take away 40% of that as CASA, current account and savings segment, so it may come down further. So the marginal cost theory, whom did it benefit? It only benefited the new private sector banks. Because you look at the profile and the portfolio of deposits mix. It is only in the public sector banks that people put their money for more than 3 years. This data is available in the public domain. You can go and check anytime. I am ready for verification. And all the private sector banks, foreign banks and all, nobody puts their money for more than 15 months. So they wanted to capture on the fact that, okay, my marginal cost of lending is coming down, marginal cost of deposit coming down, so I am able to lend at a lower rate. Similarly, there was a case with this other case which we discussed, and again finally when things came to light was the credit cards related interest rate charges. When you were saying 2.25% for a 45-day cycle. So if you are saying 2.25 to 2.75% for a 45-day cycle, effectively your annualized rate is somewhere between 30 to 32%. Okay. But now today, if you look at it statistically, the credit card usage has gone down and dropped. And even the credit card related complaints also have dropped.
Debit cards are Debit cards are
I don't know. What is the answer? The answer is something different. The answer is, see, banks have a very smart way of foxing you. Banks have a very smart way of foxing you. All of them replaced it with personal unsecured loans at 19 or 20%. So today your entire credit card portfolio has been replaced by what is called as a personal loan, anywhere between 18.5 to 20% given by so many banks. Why so many people still fall a prey to SMS and all? Your pre-approved loan is sanctioned, ready for disbursement. So this particular portfolio was replaced by that. Again an eye-opener. So to look at these gaps, in 2006, the Reserve Bank of India set up a regulations review authority under Dr. Reddy. And then we came to the conclusion that we need to have a body which will clearly say what will be the standards and codes of customer service each bank will adhere to. And that's why in 2006, the Banking Codes and Standards Board of India came into being. Now, almost all the major banks in the country, all the scheduled commercial banks for sure, all the foreign banks operating in India with a retail portfolio, and 3 or 4 big scheduled urban cooperative banks. All of them signed to this charter and they said, we will become members of this body. And what that means is, you undertake to follow certain standards and procedures while dealing with the customers, and those standards and procedures are, once you accept them, they are the minimum standards. It is not as if you adhere to all of them, you have done something great. They are the minimum standards of customer service and customer communications and customer delivery which you have got to adhere to. Okay. Now once those standards were established, again typically see what happens is, you have the standards, you create all the infrastructure, but how do the people know? How do the people know of it? That there is a standard, there is a standard setting body, there is a code setting body. So then the problem again that the RBI and all the powers that be noticed was lack of awareness. Lack of awareness is the biggest problem that we face. And is it only in India? No. We are an august company. Even in the US and UK, the people are sometimes more ignorant than we are. Okay, nothing to be surprised or worried about. Because this was clearly visible in the 2008 financial crisis, when the Senate Banking Committee in the US, when they were listening to the people's grievances and all, they said, the banker has given this statement saying, this is a variable rate mortgage or this is an adjustable rate mortgage. Both of you have signed off on the most important terms and conditions, a one-pager. How do you say? No, he said, I have signed, but I have not read a word of it. Or I have not understood a word of it. So in India, the problem is also greater because we just don't have the illiteracy of the financial kind, today we have created 3-4 kinds of illiteracies. One is the general level of illiteracy we have. Second is the digital level of illiteracy. And third is the financial level of illiteracy. So we need to bridge all these three to reach. Because today everyone wants the fruits of technology. Everyone wants the convenience. But the moment something happens in terms of a mishap or in terms of a fraud or in terms of somebody being duped or somebody losing the money, we suddenly wake up. Okay. So this was an issue that was discussed at tremendous length in so many committees. In the Damodaran committee, we discussed this for about 2 or 3 meetings successively. Every week we used to discuss on this. See, the problem there is the licensing powers which the Reserve Bank has. Now, Reserve Bank, once it issues a license to the banks, it never says how you should do your business. It says you are permitted to carry on the business of banking, provided you are in a position to repay the depositors as and when their claims arise today, now, or at any time in the future. Now, Reserve Bank is never expected to be an astrologer or a palmist or a numerologist or anything. Because, see, this 1949 Banking Regulation Act, these are the powers conferred on RBI under Section 23. In 1949, I think nobody believed that internet banking or use of technology or use of computers is going to be so widespread in delivery of banking services that it is going to pose a problem. So today the question that we need to ask is how somebody is going to say whose banking in terms of the net banking abilities or the technical abilities is safe or the safest. Very difficult. Because hacking into a system or getting into a system by cracking into its codes and this one, or a fraud, both these things you know only after they have happened. You never have a first-hand knowledge that this is going to happen. Like there's always a threat, no? Like somebody is trying to pierce into my network. So there is what is called as the vulnerability assessment and penetration testing for computer systems. Now we had mandated this to the banks that can you do a VAPT, vulnerable assessment and penetration testing, and we in the Reserve Bank did it, and we were surprised to know that in a year there were about 800 attempts to attack our network. So there is always, because today you are holding all your money and the money related data in a digitized form. So nobody need raid 800 or 10,000 branches. What you just need to do is get cracking into your database and get the data out of it and siphon it off and you are done. Okay. Just about 6 months back, we had the malware attack in the European Union. Some of the East European countries, erstwhile communist countries, holding everyone to ransom. If you want your password to be unlocked, you remit 300 pounds or 300 euros to this particular account. So the way banking is being delivered, that process has undergone a change, and we need to develop strong and robust mechanisms to find out as to which bank or which setup is the one that is going to deliver safe and reliable services in any mode. So you go to foreign banks, their website and all, if you look at it, the difference I am telling you between the Indian bank, foreign banks. You go to any of the leading foreign banks which are good in terms of delivery through the automated channel or the digitized channel. Their network access policy, the first sentence itself makes the difference. In India, if you go and look at it, all the Indian banks, their policy starts with, we are not responsible. 1, 2, 3, 4. Okay. You go to, for example, you go to Wells Fargo Bank. You go to Wells Fargo Bank. In fact, day before yesterday night, the way he was grilled by the Senate Banking Committee in the US, it is just a 38-minute grilling, and you must listen to it. This man very, very humbly saying, sorry, I have tried to hurt my customers. I'll set it right. No arguments in the newspaper, no this one, mudslinging or anything. So Wells Fargo Bank, if you look at it, his take or his policy on the same thing, the first sentence it reads, our bank is responsible for 1, 2, 3, 4. So look at the departure. We are not responsible for, we are responsible for. What is written there under may be the same, but what appeals to you as a customer? See, in fact, if there is an attack on the network, then if it has been wrongly done, then it's all the more the bank's responsibility to compensate you. Because how come somebody unauthorized was able to enter your network? It means your network is not safe. So these issues that came to the light also brought to fore the next big challenge in terms of delivery of customer services, and that was, how do you look at the liability in terms of mishaps or misdemeanors or misdeeds that may happen? So whether there is a limited liability clause, whether there is a compensation clause, whether there is a zero liability clause, or whether there is insurance. So these are the 4 things that are always available. They should be available to a customer. I restrict the liability, like now all the banks have started saying, if your credit card is lost and you have hotlisted it within 24 hours, all the transactions thereafter are our responsibility. Now this was again as a fallout of the recommendations of the Damodaran committee. Or zero liability. See, in countries like US and all, the moment you put it for hot listing, zero liability. See, kindly let's understand the difference. In US and all, we shouldn't be comparing for the simple reason. In US, any amount of compensation is possible for them because the entire society is driven by credit cards. So the amount of turnover commission they make, they're able to afford to pay any amount of compensation. Here in India, it's a fact that all the banks are making losses on their credit card portfolio. Not a single bank is making profit. It's a fact. Every single bank is making a loss on the credit card portfolio. Forget compensating, they'll try to avoid their liability. That is one of the major reasons. So they try to invent the other product, which I told you, personal loan. Okay, then insurance. See, the insurance companies also have to learn how to provide insurance for different kinds of scenarios. Today, you go to US, for every single mishap that may occur in your life, there is an insurance available. And once the incident occurs, once the trigger happens, no questions asked. No questions asked. You just file your paper, you get your money within 72 hours. Here, you still have a situation where if your car has been hit by somebody, you are always worried. You try to take the photo from your cell and all. Nothing doing, man. See, I was in Australia, let me tell you, I just saw some accident. He said not to worry and all. So I said, how do you? No, I'll just file my claim. The insurance company managed to get the CCTV footage, looked at it, who was wrong, paid the money, claim settled. So we have to migrate towards this scenario where compensation, zero liability, limited liability, or insurance, they have to come together to look at how to look at the customer issues involved. Okay. Now, if you look at the customer services itself, what are the kind of services that we use normally? When I go to a bank, I have a portfolio of services, but what are the most frequently used services? I have deposit. No, deposits, we'll say deposit as one category, liability side. I have the loan side. I have the card products. I have the remittance products. I have the parabanking products. Okay. Now, I'll just put this idea to you. Some bank says, you put 1 lakh in your account, saving bank account, and get everything free. And we will pay you 3.5%. Okay, or we will pay you 4.5%. How many of you have tried to evaluate whatever they have promised free, how many of them services and how many times you actually use them?
Normally the services are provided under such things are very rarely you come across.
No, even if they are, no, I'm not saying, I'm saying, suppose it says RTGS. Okay, RTGS free. I'm just giving an example. How many times you use RTGS? No, and okay, very rarely. And even if you use it, how much you have to pay?
25.
5 to 25, depending on what is the volume, from 2 lakhs to 20 lakhs and above. Okay. Now, even if you have used it only once, you would have paid 25 rupees. Okay. Now, for that, what you have agreed to? You have agreed to put 1 lakh at 3.5%. So, whatever is promised free, kindly look at its relevance for your purpose. Don't just, and secondly, there's a lot of clarity which one must get. Now the banks are slowly clearing the air on that after persistent follow-up and with me also talking to the DBR and all. 1 lakh is just saving bank account or my all holdings together in the bank?
I'm saving only.
No, that's what. So I'm saying again, get clarity. Get clarity. Because somebody is saying, State Bank of India now has clarified, it is 5 lakhs in your relationship with the bank. It is not 5 lakhs in saving bank account. 5 lakh in your relationship with the bank. So similarly, if somebody is saying, no, Kotak and Yes Bank, they said 6% saving bank account, 1 lakh. Now, how many of you have tried to get a clarification whether it is 1 lakh only in saving or 1 lakh in the relationship?
1 lakh is the saving in Kotak.
Again, ma'am, that needs to be clarified. They have not.
We did at that time and they announced it.
And my understanding with them, my talk with them has given me an impression. Recently, I was with them, Yes Bank, has given me an impression that it is 1 lakh in the relationship.
It is 1 lakh in the saving and Axis Bank is 1 lakh savings and about 7 lakhs for the relationship if you want things free. And I
Okay.
think Kotak-
So anyway, the short point that we are discussing is whatever you are promised free, how many times you use those facilities? So instead of that, I was just discussing with ma'am before walking in here. The Reserve Bank has also given the facility of a basic saving deposit bank account. Basic saving bank, BSBD we call it. 0 balance, ATM cum debit card and one book of 20 check leaves every year. Okay, get it. So try it. It says, because see, I'll tell you, the point is, if many of us try to do this, it becomes a moment, then the bank may have a problem of trying to rejig its strategy of trying to price the different products. See, most of the developed countries, the balances in the saving bank account are absolutely minimal. Absolutely. Today, when I say 40% of my deposits are in CASA, who is benefiting? Banks and the people who are playing in the stock market. Yeah, really. I'm not joking. See, there's also a part of financial education. See, let me tell you, in India today, we totally have a foreign investment of $260 billion equivalent. That is about, no, the total foreign investment in different portfolios, equity, debt, banks all taken together, 260 billion. That comes to around 16 lakh crores. Okay. Now, just think of it. If all of us had been a bit less conservative, I'm not saying a bit more risky, I'm saying a bit less conservative, and even 5% of the money had gone to the stock market, from the 1,20,000 crore that is there in the banks as deposit, even if 6 lakh crores had gone, many of us would have been millionaires beyond our imagination. I'm not saying pick up this particular stock or pick up this particular, no. I'm just saying, kindly remember, in India, we are the biggest enemies of ourselves as financial consumers. Because most of us tend to forget the rule of 72. And what is that rule of 72? Now, rule of 72, it works both ways. No, if you divide 72 by the rate of inflation, the number that comes, if you don't earn more than what the inflation rates are, if you divide 72 by the rate of inflation, in that many years your wealth will be halved. So if today we are talking of 4.5% inflation, or say 5.5% on average, if I divide 72, roughly in 13 years, my wealth will be halved. if I don't keep on earning more than 5.5. And the other one is, in how many years I want my investment to double. So if I even take a conservative estimate of 15%, and that is what the last 6 years simple average returns of the stock market have been. So if I had taken 15, in 5 years my wealth would have doubled. And irrespective of the stock. Because look at it, how many people who have, and in the process what we have done, in the process, the bigger problem is by putting all our money in the banks now. We have ensured that the rates for ourselves have not gone down on the loan side, but because of excess supply of these funds, the rates on the deposit sides have kept on falling. So we have been our own enemies. So if you are trying to, and mind you, we can be the biggest stock market driven economy in the world. Because there are only 3 big markets in the world. The entire European Union, if you look at it, no Germans or no Swiss person invests in the stock market. They all go by the bank. For them, it doesn't make a difference because both of them are at 0% inflation. Both of them are at 0% inflation. So you start from New York, you have Chicago, New York, then London, then the next biggest, India, and then Tokyo. There's only 4 big segments. And in Asia, Bombay Stock Exchange is the oldest, not even Tokyo. 1875. Bombay Stock Exchange started trading in 1875. So, let's be aware. And look at the numbers also. For 200 crore deposit accounts, we just have less than 2 crore active demat accounts. And in terms of density, where are the most active? Huh? Which state? Can you tell me which state is the most active? Kerala. In terms of density of DP accounts and activity, Kerala tops the list. Shocking, surprise. We all feel we are in the financial capital, but how far away we are from the real nitty-gritties of managing our finances very well.
It's the latest fallacy that Kerala is a leftist ruled state.
See, all of us, see, point is, boss, I'll tell you, all of us are leftists by heart, because heart is on the left. Okay? All of us. And money always is where your heart is. So if your heart is on the left, it doesn't matter. With respect to what is the party in power. See, they are all the people who decided to take that plunge into enterprise and go and make that money. So it was worth the risk which they took. See, I have seen in the Reserve Bank some of the most, I am telling you as an example, some of the most capable people who are working with me. Just because somehow they were not keen on leaving Mumbai, finally ended up as retiring as assistant manager. See, I told some of them, you are as brilliant as me. Many of you can easily become deputy general manager, general managers.
Mobility.
Not that mobility, see, we have to get that. Today, see, the younger generation today, they are not at all worried about where they are, because whether they are in Bangalore, some of them are very comfortable being in Bangalore, in Hyderabad, in Indore, or most of those places. So, coming back to the subject at hand, financial literacy, financial awareness. So, the 5 types of products that we used in terms of the deposit product. See, whatever the regulations the RBI says, the banks always have a two-way argument on that. Reserve Bank will never say, this is a must, this is to be done. It will never say that. It will always say, banks may. Now, how the word the banks may will be typically used by the banks? How many of you know the instruction on the senior citizens deposits? So we have said banks may, in their discretion, give 0.5% more. Okay. So how many banks use that discretion? Some of them don't give anything. Some of them give 0.25. Some of them give 0.5. Okay. Come to the premature withdrawal of fixed deposits. There also Reserve Bank says banks may charge a penal rate equivalent to 1% of the tenure for which the deposit has run. How many banks forego that premature penalty? So this is the difference. This is the difference in the way the wording is interpreted by the banks. You say, the Reserve Bank has said the same thing, may, in both the situations. But in one, you said, bank has said Reserve Bank may, why should I pay? And I said, no, Reserve Bank has said you deduct penalty. Okay. So, when you look at the deposit accounts, how many of us, when I said 40%, or even the demonetization related, because I was subsequently on the visit of so many banks and all, assuming, let's not look at the political motive, and assuming all the money that had come to the banking channel was genuine, true to you, what was the national wastage of resource? Even had that money been lying in your SB account, how much you would have earned? 2001, the 1,000 rupee note was introduced. Okay, 2001. 2016, it was demonetized. And between the time it was introduced and the time it was demonetized, the value of that 1,000 rupee note on the day of demonetization had fallen to 443 rupees. What we call as the IDT, inflation denomination trajectory. Each denomination currency, we mark it to the purchasing power and then work out what is the inflation denomination trajectory. So a 1,000 rupee note had come down to 443 rupees. Assuming you had put it in saving bank account, there was a chance that at least it would have remained 1,000 rupees. Was there not a chance that it would have been? So the point is, we are not very careful and we are not very conscious managing our finances. And these days, we look at the avenues. See, I can understand about 20 years back when there were no ATMs, when there were no net banking facilities available, when there were no card products, when there was no third-party funds transferable, or you had to rely on the check. I can understand the precautionary motive.
Sweep account also.
Again, you have come to a sweep account. Now, when you go in for a sweep account, how many of you check how much interest rate you have effectively made? What is the basis they are adopting for encashing the FDRs when your cash balance goes, and suppose I am having a sweep-in facility, I go and do a RTGS, 3 lakhs, okay, and my balance in the account is 50,000, so 2,50,000. Has the bank told you which FD they will be encashing first?
Oldest first. Oldest first.
I don't know. I don't know. Kindly go and check. And after they have done that, also check what is the effective interest rate you have made on the SB account. Because each bank, there is nothing, Reserve Bank has not said anything on this. There is a bank which followed the last in, first out. So, they said, okay, whatever latest money has come, because the older ones are carrying higher rate of interest, so we will not encash those for you. So the later deposits we will keep on putting in the sweep-in FD facility. Now, it so happened that when they put that money, the short-term FD rates for 46 days to 90 days and all, they were 4.25%. Okay, so when the question of sweep out came, they encashed the latest one, and then they said 1% penalty for premature withdrawal. 3.25. And then the saving bank interest was 3.5. So now have you made 3.5? So kindly look at, don't blindly believe in sweep in or sweep out. Look at how it affects you. Okay. Then, in terms of the deposits, most of the people have had a lot of anxiety about cash and all. That's not a very major issue. 3-4 times is good enough for depositing. But if some bank for the common customer were to say, we will not accept or anything, you can easily challenge it to the Supreme Court, straight away asking for cancellation of that bank's license. Because the initial license given to the bank clearly says, set up for the purpose of accepting deposits in cash and checks. Okay, so there's nothing to be worried on that front. Okay, this is about the deposits. The other major problem which you face in terms of the deposits is the area of deceased depositors. Okay. How many of the banks paid to the nominee? How many of them paid to the nominee?
They're supposed to, right? I mean,
A lot of fuss.
they make you fill up some forms and that's a source of...
Ma'am, I'll tell you, there are two things. One is, the Reserve Bank of India has clearly said, if the amount is less than 1 lakh rupees, straight away, no indemnity, nothing, take the signature, fill the form and all. Now, recently the Supreme Court judgment, if you look at it, again they have reiterated the same thing. Even if the money is paid to the nominee as the holder in due course, the bank is discharged of its liability, because the nominee who is receiving the money is holding it in trust on behalf of all the heirs and legal heirs and other claimants. So the banker need not be worried. But artificially these people try to create a scene as if they are the people upholding the principle of equity and all. It need not be there. Because there again, the moot point is, if you have refused to pay on that count, then at what interest rate you are going to pay the claimants?